Welcome back to Hedge Fund Manager. I'm Karl-Mikael Seiding. So this is the second part of the fundamental analysis, part of the deep dive of FX. We finished off with noticing the high return on equity, currently at 39%. That's incredibly good. But also looking back 10 years on a quarterly basis, we can see that the average level is maybe at around 25%, and it's been increasing over the years. They are getting better and better returns on equity. This is a highly efficient company that is really coming into its own. I mean, this is still a pretty small company. It only has $16 billion market cap. That's less than a 200th of the absolute largest companies. So as FX keeps growing, they actually have the potential to increase the returns on equity, simply because they are that small in comparison to the total economy, and they are still increasing their economies of scale and their efficiencies and becoming more and more of an established, well-run company. And if you are growing at a 25% clip in terms of return on equity, that means that equity, if you keep it in the company and keep having these returns on equity, equity will double every 3 years. And that means 2x, 4x, 8x, 16 times the equity after 4 times 3 years. So after 12 years, they will have 16x their equity. And this actually means that despite this being an operational company, where the value driver should be earnings and price earnings valuations, things like that, you could actually almost value this company from a price book perspective, and that is highly unusual, and that gives us some added security and less uncertainty about the valuation and the risk level of this company. We can see that this is not just theoretical. Look at how their common equity is exploding upward. Over these 9-10 years, they are growing from maybe 300-400 to 1.8 billion. So that's a 5x around that, something like that, 5x in these 10 years. And they are accelerating toward the end of this period. Really good fundamental numbers. Now we have established that from a fundamental point of view, they are growing quickly and reliably. All types of fundamental numbers, be it equity or earnings or sales, the growth rates, their various return numbers. We can also see that where they did have a little bit of a problem, just the last measurement of cash flows, it was explained in terms of the pattern for their days payables outstanding. It still warrants checking a little bit more closely what's really going on with their days payables outstanding and their net working capital, and what the actual signal here is in that respect. But I would say in general, we can actually rely on their growth numbers and perhaps just pull them down a little bit when we're making our forecasts and make them more generally reliable, rather than expecting and forecasting that they will keep growing at these exceptional levels, because we don't actually need them to grow this quickly. But if we were to put in the hours and days and weeks and really getting to know and understand this company from a truly fundamental basis, from an operational basis, as we grow more and more certain of their capacity of delivering that type of growth and profitability for longer and longer periods, we would also be more and more comfortable in calculating what type of value they would have if they actually were to succeed. But now let's move over to the valuation part. As I said, we can almost value this from a price book perspective. They are at 9 times book. But that's actually quite okay if you can expect them to 16x their book equity in 12 years. But this would not be my preferred valuation multiple. Price book is more commonly used for real estate and bank companies where the actual value driver is the book equity, not the earnings numbers. We can see here that their EV to sales multiple has moved from an historical average of around 1, something like that, but now they're in the 2x range the last few years, and they are definitely worth 2x sales, considering that they have almost a 10% net income margin and they are growing much faster than the average company in the market. So. And if we look at the price earnings multiple as a complement, it's now at 27 times last 12 months, and it's actually at 23 times the coming 12 months and the forecast. And considering that the company is growing by at least 10 percentage points faster than the market, which means a relative doubling over 7 years using the rule of 70 or rule of 72, then you should absolutely be prepared to pay more than, slightly below perhaps 2 times the market multiple. And at 27 PE and a 27% EPS growth. Remember that we concluded that they should probably be able to grow EPS by somewhere there, about 20 to 30% perhaps. They are at a PEG ratio of just 1, and the hammer PEG is actually at 2x with a price earnings ratio of 16 times last 12 months and just an 8% average EPS growth for the market in historical terms. So we actually get FX at just half the PEG ratio of the general market. So that's at least an indication of really good value. Even just checking the EV to EBITDA multiple, it's at 14.5x, and that's also from I think surprisingly low, although it's in the upper end of their usual historical range. But I think the explanation simply is that they have been getting better and better and better, and their margins are expanding, the return on equity numbers are expanding. This is a company that is becoming better and better, even from a quite high quality starting point. So let's just recap the P equals F times V method in a nutshell. So what we want to do is take historical numbers and extrapolate them into the future. We do that with fundamentals, so sales and earnings, and we do it with the valuation multiples, for example, PE and price sales and even maybe price book. Then we use these numbers to forecast a plausible future stock price, either range or a point estimate, just taking fundamentals times valuation. And then we calculate what that means in terms of annual returns. That is, one part is how much will the stock price appreciate every year, so that's the F, and then how much will the valuation multiple change over that period of time. So for example, from PE 27 to PE, well, we haven't decided that maybe should it increase to PE 35, or are we forecasting a falling price earnings ratio in the future to maybe 23? And then we add in the dividends, and this gives us the total annual return for the period that we are talking about, and then we use that to compare it to other stocks.